Morning, guys. Everybody hear me okay? See the 15-minute chart? Cool. All right. Thanks, Bob. Tom, good deal. Hey, Wayne, Julius. Okay. I'm going to try to keep it a little simpler today. I have 4 charts on this workspace, but we're basically just not even going to use the 15-minute. So we'll focus on 3 charts. And I'll jump into that in a second. I want to let a few more people join. And then I'll kind of explain how I put all this stuff together and then how I went about testing and proving those ideas. Okay, let's jump into it. I guess we have as many people as we're going to have. Vito, yeah, there will be soon. Vito's asking, is there a reader manager update coming? Yeah, there will be, but it's going to be an import manager where you guys will be able to import all of the market geometry analysis that Josh and I perform. So we'll actually be able to export that to a server, and then you guys will be able to import it depending on what you're signed up for. If you're in the trading room, you would get at least one market with the trading room, at least. And then if you just own the toolbar, then you can sign up for each market individually. So yeah, that's coming. We still have a little bit more work to do with the server and sort of the user experience, the UI and everything, how it works, how it looks. But yeah, it's pretty amazing, really, that we can even do this. And I think it's going to be appealing to a lot of people because this is kind of the hardest part of what we do, is performing the analysis properly, drawing in the areas. I can remember when I first got started with this, I would always ask, well, why did you choose that high? Why not this high? And over time, it just kind of becomes obvious and second nature to you. But the answer was always, well, that's where major supply came in, or that's where major demand came in. That was the major swing high. That was, kind of the obvious spot to select on this chart. So it's really, as far as determining, how you're drawing it, where you're drawing it from, it's a function of the chart that you're drawing on and the size of the swings. So for instance, on this 15-minute chart, I wouldn't want to draw the market geometry, like using these little swings in here or something, right? I would draw that one on, say, the 5-minute. Maybe the smallest one that I would draw would be this one. You see? And it came right up to the top of that channel on that huge buying climax, followed by a churn bar. So when you're first getting used to this type of analysis, it's, I think, a little bit overwhelming. And that service, getting our analysis directly to your charts, I think is going to be pretty important for a lot of people. All right, so the way that I put all this stuff together, I know a lot of you guys already know this, but I was working at that sort of mini fund. I guess it was just we were just managing private money. And they were using market geometry. They were using trend channels, median lines, and about 3 different time frames. So like a weekly, a daily, and a 240-minute chart. And they were also using volume, but mostly just on the daily and the weekly charts, a kind of Wyckoff style analysis. So that's how I got started. And then, I had to read all these different books on, basically what I was doing was studying to become a market, a CMT, I think it is, a certified market technician. There are a couple of different exams, but I was studying for that and reading all these different books. And, it kind of seemed like this sort of analysis, I don't know if you would say it became outdated, but as time went on in the field of technical analysis, people started shifting towards, equations, trying to, apply physics to the markets and all these different oscillators and moving averages. And, it seemed to go in another direction when computers came into the fold. So I think a lot of people overlook some of the older methods. I don't know if it's just the way that people were back in the teens, 20s, and 30s. I mean, I know you've had charlatans all throughout history, but it seems like you have more and more people claiming things as fact now that are just simply not true, that you couldn't possibly prove. Whereas with some of these older methods, such as market geometry, there's a lot of documented evidence as to the validity of it. And it's pretty easy to prove to yourself anyway. Long story short, the most important methods that I knew worked were, number one, market geometry, and then number two, the volume analysis. So I went down the road of doing all these different systems and testing all these different ideas and building strategies and testing, and nothing really seemed to work very well, but just a simple application of market geometry and volume analysis helped them produce consistent returns. So I wanted to take those consistent returns and turn them into, 1,000% a year kind of a thing. Of course, fresh out of college with student loans, yeah, naturally you want to make 1,000% a year, right? So anyway, yeah, I think it's naivete and greed, I guess, sent me down the road of trying to do better. And, I wouldn't say that I failed because I learned so much. I learned so much about what works and what doesn't. But I did end up coming back to what I knew worked. And then after working with so many people building bloodhound systems and basically seeing that just about everybody has the same sort of biases and ideas about what works and what doesn't. A lot of people love just a bunch of random indicators all over the charts. And of course, it's pretty easy to prove that that stuff just doesn't work. So I got back to what does work. And rather than starting with, a bunch of really precise rules, because I already knew that that sort of thing didn't work from all the testing that I did with Bloodhound and manual testing. Manual back testing. Because I knew that, I tried to determine what causes these major swing highs and lows. Why do they come in the way that they come in? What are the similar characteristics of all of these major turning points, if anything? Do they have anything in common? And why are they occurring where they're occurring? So I wanted to first I took thousands of screenshots. I wish I still had that stuff, but I lost so many hard drives before I became diligent about backing everything up. But anyway, I tried to find similarities between the major turning points. And in doing so, it became glaringly obvious that supply and demand conforms to market geometry, and the volume is the most important confirming indicator. And then when you're using volume to confirm, and when you're applying the market geometry, it's essential to have multiple time frames, because if we're looking at, for instance, a swing high right here, well, this is a pretty sizable move, isn't it? Just in the last leg of it, we have over 211 ticks, over 51 bars here. And I would say the whole pattern there is from here. So that's about 100 bars on a 15-minute chart. And that's a pretty important swing high. There's really not anything to the left of that. The first major swing high similar to this would be this one back here. So it doesn't really make sense to compare what's happening at this swing high with what's happening at this swing here. You see what I mean? So you wouldn't want to say, oh, well, there's, these swing highs and lows are just kind of random because you have all these different things happening here. There's really not a whole lot in common between them when you're comparing different swings like that. So you want to compare similar size swings. You want to compare similar patterns. And the way that I approached the whole dilemma, I guess you would say, about patterns, there's so many different ideas about patterns. You have tons and tons of books on patterns. A lot of people have rehashed all of that, Gartley and Butterfly, and that original book, I think from the 50s, that sold for, back then, I think it was like a few $1,000s for that book. So a lot of people have rehashed that, and you have all these conflicting ideas about patterns. I took the idea of from Elliott Wave, basically looking at impulse moves and then corrections. So I would apply everything that I was looking at as far as what's happening at major swing highs and lows in light of corrective waves. I was analyzing all of the major turning points to try to identify what's happening at the end of a trend, and then also at the end of every major correction within that trend, and then trying, like I said, to identify similarities between them. Basically comparing the major swing highs and lows in, or let's say with a kind of a roadmap. And that roadmap was pattern recognition. So looking at, everything that we do in trading is pattern recognition. Even if you're building fully automated systems, you're looking for patterns. That's what this is all about. And that's kind of our nature, right? As humans, we seek out patterns, and we can do that, of course, better than any computer ever could. So that's another issue that I had with this sort of pattern recognition. You can't really program these types of things. I imagine you could get close to it after 4 or 5 years of intense programming and writing out all these huge rule sets, but the human mind, the human eye can see these things much more easily, readily, and make more sense out of them, obviously, because a computer can't make sense. But these sort of things had to be done discretionarily, okay, even to test them, especially to test them. All right, so that was the idea. I didn't want to start with a bunch of predetermined rules based on what I thought. I wanted to really see what was happening at these major turning points. And in order to do that on intraday charts, I had to have relative volume, okay, because of, I don't know if you guys, I'm sure some of you don't know what relative volume is, but if you're looking at the raw volume data on, say, this 15-minute chart, let me just add it to make it absolutely clear here. If you're looking at the raw volume data, you see maybe not as pronounced on crude oil as it is in the US equities indexes, but you see the seasonality within the session, very high volume at the open, kind of a lull during lunch, and then it picks up before the close. Okay, and then you see the wide variance between the sessions, right? Very little in the overnight, picks up in the Euro session, and then triples or quadruples during the US equities market, US business day. So to compare this volume with this volume is essentially useless. You're not going to get very useful data out of that. So we had to filter the volume data in such a way as to compare each time period, each bar's time period, with the same time period. So we're comparing the volume for this bar with an average of the volume for that time period. And that's what the relative volume is. So that's why you see here at this high, which was the major swing high recently in crude, you do see an uptick in volume, right? So compared to the previous bars, yeah, that's a huge amount of volume, but it's fairly difficult for your eye to pick these things out quickly when you're seeing big bars like this, and then you're trying to compare it to that. It just doesn't register that this is actually a huge amount of volume. And it's a huge amount of volume because when you compare it to the average volume for that time period, 630, it's 11 times the amount of volume that typically transacts for that time period, you see. And then when it comes to supply and demand, which in my view, from what I can prove, is, I don't want to say governed, but it forms or it flows through these type of geometrical patterns in the market geometry, which is very, very easy to see, which I think you'll see here very quickly. It also shows up, though, as it's rejecting from those areas with very high volume per range. Okay, and that's what a churn bar is. So you'll hear me start to talk about looking for a churn bar to confirm the major turning points, to confirm the areas that I'm wanting to trade. All right, so rather than starting with a bunch of rules, we'll kind of start off doing what I had done so many years ago, and simply require that we have two charts. Essentially, we have a bar that's touching two different areas in the market geometry, and that we see some volume come in at those areas, confirming that we do have supply at a high or demand at a low. And that's it. And what we'll do from that, and I'm not going to require that an area be sloping in favor of the trade or anything like that. We're just going to start with these couple of basic rules, two areas in the market geometry. That defines the area where we want to do business. And then a very simple confirmation. I want to see a churn bar. I will add in some volume divergence, on the 5-minute or this 90-second chart that I'm using here. But rather than requiring it, we'll just make a note when it happens, kind of a thing. So what we'll be doing is we'll be registering every case where we have two areas in the market geometry defining where we want to do business, and we get a churn bar coming in to confirm those areas. Okay, we'll register that trade. We'll log that trade with the trade tracker. And then just very simply, we'll exit target number one at the very first area in the market geometry that we could possibly come to. Let's say it has to be at least 2 times the average range of the 5-minute chart away from that area. And we may use the average range from the 5-minute or the average range from the 15-minute, depending upon the size of the swings that we're trading. And I'll try to explain that as we go. But I had started to get really carried away with this and have all of these rules. It would have left you guys just scratching your head. Nobody would have gotten anything out of this, except maybe a very few of you that have been doing this for a long time. Rather than going that route, I've decided to do it a bit more simply, sort of show you how to begin this process on your own, because most of you, many of you, at least the majority of you that have just recently started trading, let's say within the past 2 or 3 years, you probably don't have this long list of rules. Hopefully you don't, actually. I would say it's better if you don't. If you have, a really detailed trading strategy, and that's what you're using to base your entries and exits off of, if it's more than about 5 or 7 rules, then chances are it's not a profitable system. Now, that might make you mad or, whatever. You might just be completely incredulous right now. But trust me when I say that the more rules you have, the worse the performance. It's just a fact. It's the way it is. So we're not going to do that here. We're going to start with just a couple. We'll log the trades, then we'll go back and start to compare similarities between the winners and similarities between the losers. Please tell me that made sense to you guys. Indicator at the bottom of the panel. You mean the divergence indicator, this one? It's the TSI. So basically what I've been doing, when you're looking for this every single day of your life for years, it just becomes, pretty obvious to see it in the price action. You don't necessarily need an indicator to tell you, but if you're trying to do any of this stuff programmatically, well then yeah, you have to have it pretty clearly defined so that you can build signals from it and do the type of testing you want to do and all of that. And to be able to teach it to other people, well then yeah, it would be much easier if it were visual. So that's the whole reason that I have the Divergences Pro indicator. Number one, to see it quickly, but more importantly, to be able to teach it to others and to be able to test it within Bloodhound and Blackbird. And let me just explain very quickly here the difference between Bloodhound and Blackbird and what we're doing with the trade tracker. So with Bloodhound and Blackbird, we can automate, well, you can automate anything you can think of, really. And we can build all these different rule sets that we can then back test, right? But what we're doing, because we're having to apply the market geometry manually by hand, we can't exactly run a proper full back test, right? Because everything would have to be 100% automated. And the market geometry is not 100% automated. We actually have to perform that by hand manually. And when any of your, any aspect of your system is discretionary, then fully automated back testing is not really feasible for you. You can't really do it. So, that's why we're using the trade tracker, because we do have these different discretionary sections or methods within our trading strategy. Number one, the market geometry. Number two, the pattern aspect, looking for corrections in a trending environment, a type of, I'm hesitant to call it Elliott wave, but the patterns defined by Elliott wave, the corrective patterns, you see these over and over and over. So rather than, trying to label and number every single little swing within the market, we're essentially using that as a sort of roadmap. We want to see a trending move, then we want to see a corrective type move. And those tend to recur in recognizable patterns. So most of the pattern recognition type stuff is very difficult to program, especially Elliott wave and market geometry. So we can't exactly perform a fully automated backtest, which is why we need the trade tracker to be able to log our trades, the trades within our tests, as quickly as possible, and be able to flow from example to example and be able to do this sort of thing in a matter of hours as opposed to a matter of days and weeks. You guys see the difference now between what we're doing here with the trade tracker and then what we can do with Bloodhound and Blackbird? If I could 100% fully automate every single aspect of what I'm doing, well, number one, it would be suspect to me. I would be fairly incredulous that it would, I wouldn't believe that it would perform very well. I have a little bit of suspicion when it comes to fully automated systems, especially people that are selling them. What are you going to do? You're going to pay 10 grand for a fully automated system and then make 10 grand a month for the rest of your life? Does that sound reasonable to you? And yet people do it every day. A lot of people sell stuff like that. At any rate, what we're doing is trying to have at least some rules that we can test our performance against, some rules to define the areas we want to trade, confirm those areas, and then the rest of it is based on discretion. That's where the difficulty comes in, and that's why everybody wants to have a fully automated system, of course, right? Because you don't want to have to rely on your own discretion. Who does? But when it comes to trading and good trading, it's all about becoming a better and better trader. So let's get right into it here. I'm going to start, because this stuff is pretty detailed and it does take so much time. I am going to start, I guess we'll get as far as we can in the next hour or so. But I'm going to start with this Monday in crude, and we're just going to start marking it up and logging some trades here. You guys have any questions before we get started here? I know that was a pretty long introduction, but I think it was necessary. Of course, most of what I do is completely extemporaneous. So maybe I went a little longer than I should have, but hopefully you guys found it useful. Yeah, so to answer your question, Bruce, I'm using a TSI, True Strength Index, on the minute charts, time-based charts, and then I'm using balanced momentum on the non-time-based charts. So TSI rather than RSI, because it is somewhat unbounded, the TSI. It can potentially go way above 50 or way below negative 50 in a very, very strong, high momentum type of environment, whereas the RSI is completely bounded at 0 and 100. Okay, so the TSI is, we're talking about equations on price action here, but it makes more sense to me than the RSI does. That's why I'm using that. All right, so we're going to start with Monday. And the way that I'm doing this here, let me reset everything. Okay, let me just kind of walk you through how I've added the trade tracker. First, I'm putting it here on the left so that you guys can see all three charts on one screen, and I don't have to flip around here. I'm going to show the prices, the labels of the entries and exits and the stop and everything. Going to include slippage, only one tick for the stops. Let's just make it 2.6. Include commissions, yeah, 380 around turn. Starting equity 10 grand, so I'll trade 2 contracts with 2 targets, 2 separate targets. First target will be at the first area in the market geometry. Second target will be at the next major area or the next volume divergence against the signal. Well, I'm not going to confuse you with all that. I'll show you as we go through here. I do at least want to have some kind of basic rules for where and why I'm going to exit. And then without fail, I'll exit by the close of the day. And this is the little time zones indicator that Adrian is throwing in with this for you guys. It does actually make it a lot easier to see this, the start and end times of the different sessions, rather than always having to check the bottom axis there, the time axis. So the way that I've set it up, basically between 6 and 11, I seem to do my best. And then as the day goes on, naturally because of decision-making ability, the more decisions you make per day, the worse they get, right? As time goes on. So between 11 and close, that's where I tend to get in trouble. So I can have a great morning and then I can give it all back and then end up down for the day when I continue to trade. So I've got this one in white with, very little opacity. So it's almost transparent. And then this one in red. So we're set up for a new test. I think I'm saving it properly here. I've got it set to dynamic so that I can do custom exits. I can select the exact bar that I want to take target 1 off, the exact bar that I want to take target 2 off. I can pause it, which is essential for what we do, especially when you're doing multiple time frames here. First target is 1 contract. Second target is the last contract, obviously. And I'm not going to worry about moving the stop. I want to leave it right where it's at, sort of look at all of the information combined and be able to extrapolate that or mine it to some extent and figure out, within how many bars was my maximum favorable excursion, within how many bars was my maximum adverse excursion. Now, you can get a little technical with this, with the MFE and MAE, in that he's allowed you here, which is pretty cool, I think. What he's allowed you to do here is track what happens after your exit within how many bars. I think he has it set to 100 by default. I think, to take that even one step further, it would kind of be cool to track 2 separate MFEs and 2 separate MAEs, to have one, for the trade itself where you actually entered and exited, and then what happened within the next 100 bars or whatever, So I think that would be a nice little addition too in the future here. But I'm going to leave this maximum favorable and maximum adverse excursion, which of course, maximum favorable excursion is how far did price go in favor of your trade, and then where did you exit relative to that? That's your exit efficiency. And then your maximum adverse excursion, how much did the trade actually go against you compared to your entry, and that is your entry efficiency. Okay, so those are 2 very important numbers. But I'm going to leave it, of course, to the actual trade itself and not look into the future. So you see, I don't have the delete chart button or maximize or minimize. And that's because when I'm doing this, it's very easy for me to delete the chart on accident. Well, then you have to start over, don't you? So we built this into the toolbar where you can hide the borders. You see, now they're back. Click it again, they're gone again. So that makes it, just kind of safeguards you against wasting time, basically. So I can double click on the top bar and it'll maximize or minimize. You see? Yeah, it actually is pretty cool. And then we'll get into this chart sync button here that allows us to do this really controlled bar by bar type analysis, which I think let's just go ahead and jump into it here. So we're on the 28th. Let's go back. This little chart sync button is what makes this so much easier for multiple time frames. this chart sync button allows you to sync up the charts so that you can scroll bar by bar. But you can see when you click from one chart to the next, well, because it's always offset by one bar so that you can't look into the future and use that hindsight bias for your backtesting, which is the biggest problem with backtesting, manual backtesting, that is. So that was a problem doing this, because what you want to do is you want to enter the trade, you want to scroll forward a little bit, and then you kind of want to blow up the chart, draw in the rest of the market geometry, and then be able to go back to the mother chart or the parent chart and continue to scroll. But you see that issue there? So we've added in this little functionality where you can right click on the button and you can set each other chart, your child charts, if you will, as a slave. So now if I move this one, it doesn't move any of the others, but if I move the mother or the parent, it moves the others, you see? So now I can use the manual, the trade tracker the way that I need to, and do this sort of bar by bar work as efficiently as humanly possible, which is really everything that I've done over the past several years is to make my analysis as fast as possible so that I can take advantage of more and more setups, potentially more and more markets. And of course, to pay for all of that development, I've made all of the tools available to you guys. All right, so this is the start, 27th. Let's see, it's Tuesday, actually. Let's go back one more day. So yeah, my aim, my goal is to be as efficient as possible. It's not easy, believe me. All right, so we're going to start right here. This is Monday morning this week. We want to see a bar come together with at least two different areas from two different charts. We've had a very strong move to the downside here. We've taken out a major low. This low has actually taken out the previous low. So it looks like we're moving down pretty fast. Okay, so I'm looking for any bar coming together with at least two different areas in the market geometry. So what I do when I scroll back like this, in order to not have that hindsight bias, number one, if you were connected to the data feed and data were coming in, you would want to disconnect from the data feed. But also, you want to reload the chart so that you cannot see the objects that are drawn on the chart by any of the indicators. That is, if you're using indicators. All right, so now that I've reloaded everything, as we scroll forward, we won't be able to see what's happening from the indicators in the future. And I've also sort of closed the gap here between the right margin and that most recent bar, which is right here, right side margin in pixels. And you get to that from right-clicking on the chart, going to properties, and making that number a little bit smaller. So I'll start with the tick chart. In this case, I'm just using the most recent major swings. Looks like we're already at the top of that one, actually. So with this, these are all the warning lines up above here. I'm drawing both trend channels and median lines at the same exact time with one click here. So a lot of times you can get, a lot of warning lines all over the place, and just to hide those, I've got this little hide button here. Okay, so these are the most recent two swing highs. Sorry, swing lows. This is the low before the low, you see. So I have just a little bit higher. I've got that upsloping median line and the 100% warning line there. So that's a pretty major area that if I had a bar touching both of those at the same time, I would be pretty interested in here. So just a little bit higher, we'll have 4 different areas, or at least 3 different areas just on this one chart. And then here on the 5-minute, same sort of thing. If I don't want to have to redraw those, I could just simply copy from here with the copy button and paste that right there. So those are the same areas. You've already got your big buying climax followed by a churn bar right there. You see it? So you're already getting the volume coming in, and I'm pretty sure we've ticked out that high. Yeah, of course you have. At any rate, it looks to me like we've got, at this point, an A, B, and a C, and we've either already made the high or we're about to. You see that? So we're just getting into 6:15. I started it at 6. Basically, I want to be ready to trade at least by 7, preferably by 6:30. So I'm allowing myself to start logging trades at 6. All right, so now we're going to start scrolling bar by bar by bar. So I need to set this to the slave. And now I can start scrolling from right here. And I'll use the right arrow key. You see? The right arrow key. So it's going bar by bar. You see that? Now at this point, I've got a couple of new swings I could connect to, but I don't really need to. I've already got all the areas that I need up a little bit higher. But I could add that one as well. That's the highest high. Okay, there is our big 2-bar pattern there on crude. Now, this is kind of the tricky part here because we're at 86, 87. We're not going to see that full next 5-minute bar until after we've passed the end time, the time of the close of the bar. Okay, and we did that specifically here, offset by 1 bar so that you won't get ahead. You can't look into the future. So we've done that purposely so that you cannot continue to use that hindsight bias there. All right, here's my extreme churn bar now. What does that mean? At a high, that means that I have a huge amount of supply coming in at that area. And you see the high there is 88. So that means I'm actually up here right now. So that's why I've left these crosshairs on. So the high of the bar is at 88. That means I'm up here and actually right there, right now, and I'm touching everything. I'm touching multiple different areas there. Okay, we didn't make it up to the top of this one, but this is a, an incredibly strong and way too steep channel anyway. All right, so at this point, I want to enter right there. This is the confirmation of that area. So I click on Tool, choose Entry Location, Price, and Bar. I'm going to say I got in right there, about 86. Now I want my stop. This is the average range indicator here. It looks like we're about 10 ticks average range on the 5-minute, about 5 ticks on this 90-second. So I'm going to make it about a 12-tick stop. Okay, so that's about 86. Yeah, doesn't necessarily have to be 12. Let's just make it like a 10. So we'll put it at 96 right there. Oh, dang it. Did you see what I just did? That's the number one way that you mess this entire thing up. Can't believe I just did that. I clicked on the arrow right button. Wonderful. Totally perfect. Let me pause it here and scroll back. Now you could, that's just ridiculous. You could make this a little bit more difficult to do by right-clicking on the axis right there, selecting Properties, and then changing the margin here. This is probably advised, very advisable. Set it to like 40, maybe 50. And I'm going to increase that margin just a little bit more to keep me from doing that again. Help keep me from doing that again. So yeah, be careful that you don't hit that black button there. So now I need to reload these two. All right, so I've reloaded these. Still have these slaves. Yeah, okay. So at this point, again, we're at the top there, top of all these channels. So I click on Tool, the exact bar and price that I want to enter, and then 96 for the stop. Now at this point, very important step, you have to click on the pause button here. So I click on pause. It says I can right click to reset, completely eliminate this trade and start over. Or I have to go back to the pause button, click it, and then I can set my targets. All right, so what I want to do now is scroll forward. What's the next area? What's the main area for the first target? What do you guys think? For me, it's obviously this baseline right here. It's this baseline. Let me just show you a little bit about this. So I'm going to hide the warning lines. All right. Here we have this huge churn bar. It doesn't look huge because it's on a tick chart, but that's very high volume per range for a tick chart. We clearly have supply coming in at this high. Now that's at the top of this upsloping channel, and it's at the top of this upper median line here. So if we're going to reject down, you tend to go, if you're rejecting from an upper median line or a lower median line, you tend to go all the way through to the next one. So from upper to lower, lower to upper. And you can quote me on that if you feel like it, but that's what I see over and over and over and over and over and over again all the time. The only thing that we have in the way between those two is where that center median line is actually intersecting that uptrend line there. So it's not very far away, but it is over 20 ticks. So that'll be my first target. And then, of course, I want to make it down at least to that lower median line, preferably to a new low, but you know, you're not always guaranteed that's going to happen. Well, you're never guaranteed of anything in trading, obviously, but that would be my best target. Upper median line to lower median line. And you have the same area here on the minute chart, but the reason we use the minute chart and the tick chart is because there are fewer bars in the overnight session on the tick chart. And when you're drawing the most recent market geometry, the areas can be quite different between the tick chart and the minute chart, which is why when you're doing this type of analysis, you absolutely have to have both if you're going to see the full picture. You really do. If you're only doing swing trading, you could, you know, probably get away with only larger minute charts. But if you're doing any intraday trading at all, then you really do need both. Here on the minute chart, that area is actually a little bit lower. You see we went through it, but we went through it right to the symmetrical, perfect kind of a move here. See this ABCD deal? That's showing you that that bar is intersecting the perfectly symmetrical move here. So if this is A up, C is exactly equal to A, both in time and price at that point right there. Okay, so the next area is basically the same on both charts. It's right at 60. I know this is taking a while, but this is what it takes to explain it as I'm going through it. Obviously, if you have done this for a while and you're to the point to where you can, you know, go bar by bar pretty quickly, you can get through a week's worth of data in under an hour and a half. So that may sound like a lot, but it used to take me pretty much a full day to get through a week's worth of data, one instrument. All right, so it's still paused, but I'm going to go ahead and scroll forward because, you know, maybe my stop gets taken out anyway. All right, it is coming down. I'm looking to get down to 60. What I could do at this point, see, I've already hit it here. So we've actually made it to 60 at this point, but this bar hasn't closed yet, so it's not quite showing it. The way that I'm doing this, how I'm planning on testing this, and the way that I'm wanting to gather the results is just to simply take the exit, regardless of whether you get a churn bar, it goes straight through it, or whatever. Actually get out at the exact price where that area, that next area is. So if I can just select that line and copy it over from there to here, I can now click on the pause button, click on custom exit, and I can select the exact bar and price where I want to take that first exit. You see that? This is such a cool little tool. I wish I would have had this so many years ago. All right, then I click on pause again, and now I can start scrolling again. So what's my next area? Well, my next area is down here. It's that lower median line. But if I get a 2-bar pattern, a big selling climax followed by a churn bar on the 5-minute, or if I get a really great looking volume divergence that ends on a churn bar here on the 90-second, well, then I'll get out. Otherwise, I'm not going to get out until I should probably have some sort of trailing, hard and fast trailing rule so I don't give everything back. But that's the sort of thing that you develop after you've gathered a lot of statistics, you see. So I'm not going to worry about trying to do a trailing stop and all of that. I'm either going to get stopped out on this next one, or it's going to make it to the next target, or I get a big 2-bar pattern on the 5-minute, or a volume divergence with a churn bar on the 90-second chart. So now I'm scrolling forward. My next area is very obviously at 40 right now. Okay, we're almost there. It's now at 45, which we came pretty close to it. But here's the problem at this point. So we are using both tick and minute charts, right? Both tick and minute charts. And like I said, the areas will be quite different, especially when you're connecting across 2 sessions, across the overnight and the day session. So in this case, we went through the area, the upper median line. I'm looking at this upper median line. Let me just go ahead and delete this one now since we're not using it here, because we're looking for the target now. Okay, so I have a couple of options here. I can draw this one, but we've clearly already gone through the bottom of that. So I'm really looking for the larger target for the second one. That line there at 45 is this line on the minute chart at 35. So I could either take it at this one on the tick or this one on the minute. In this case, I'll take it at this one on the tick because we turned down so perfectly from the upper median line there. You see it? Maybe it's a little easier to see now that we're not showing all those other lines. So this is the penultimate low to the ultimate low, next major swing high. So this is demand, demand, supply, next major area of supply, right there. You see? And then what happened here? Oh, you had demand come in. Then a lower high. Now you're looking for some demand to come in off of this area. And it may just go right through it, but that's your next best area for demand to be coming in. And then on the minute chart, again, it's right here. All right, so we're scrolling forward. So at this point, I want to exit right there at 49. 49. Now I want to click on pause to resume and then custom exit for 2. Yeah, so that one's logged there now. So now we want to scroll forward. And what time is it? It's 9 a.m. So now we're looking for basically any retracement to the upside. I am putting some constraints on this. I want to have at least a 40-minute retracement. Okay, so I'm not going to take a lot of these little tiny retracement swing highs. I want to have something, at least a 40-minute retracement, and preferably more than 2 times the average range of the 5-minute, preferably 3, but let's just say at least 20 ticks for these examples here. All right, so I can delete this one. That one's logged. And let's have a look here. So now, and you want to do this without any hindsight bias. Now it looks to me like we're about to be going down and breaking this low. So at least this is like an A, B, and a C or something. Maybe it's a 1, 2, 3, but it looks very much like it's about to break this low. At this point, I just simply want to use the most recent and major swing highs and lows to try to determine where supply and demand may come in. So from here, that's obviously a major swing low where demand came in. This is obviously a major swing low where demand came in. Let me just draw a simple channel. Okay, so it looks like we're about to break through some pretty major support. And then the next one below that would be this center median line here. And that's at 65. So that's about 40 ticks lower at this point. And then the same on the 5-minute here. So from low to low, this one looks like it's coming in a bit lower than the one on the tick chart, because the one on the tick chart we're there right now. So this is coming in a bit sooner than 65.05. It's at 65.30. So that's the next area of support on the 5-minute. And that would maybe coincide with a slight break of this low. We'll see. And then I would connect high to high here. And then similarly to the tick chart, that's coming in at about 65, I don't know, 65.02, 65.05, something like that. And then I would draw from high to high, but in this case, I'm not going to get into all the nuances of market geometry. Let's just get this thing going here. So long story short, I've got some room down at least to that trend line here. And then below that, 65, just about 65 even, and then about 65.80. So that's essentially, that's the gist of market geometry. You're trying to forecast, you're trying to anticipate where the next likely areas of supply and demand will come in. Everybody, we're all on the same page on that, right? Anybody not really know what market geometry is, or trend lines and channels and median lines? I imagine most of you guys, if you've been following me at all, you know it. All right. So now we're looking for a move down. If it does turn up here, I don't want it. I'll just have to watch it go up without me. So we're looking for any retracement back up that's large enough to trade. So I do have this little swing high and this swing high. All right, so at this point, don't have a whole lot of large areas of supply and demand on this really fast chart, but I would, if I were looking for smaller setups, I would draw this one here, maybe without the median lines at this point, just from low to low. All right, so let's start scrolling forward. All right, you're getting a bit of a retracement now. At this point, I would connect to the lowest low where you've had recent demand come in. You do have a little area right here, but again, I'm looking for at least a 40-minute retracement. So I doubt I'm going to have any kind of a setup there. No, not at all. Now it's breaking down. We're going below the A wave low. So we are probably coming up on a swing low. That might be it right there. Yeah, that looks like it's clearly it. So at this point, what time is it? 10 o'clock? Yeah, at this point, I'm looking for a long, potentially a higher low with a V bottom like that. So if any of you guys know much about corrective waves, V tops, V bottoms at the end of a correction, a lot of your C waves will do this exact thing right here. They'll do a V bottom at a low, corrective low now. I'm not talking about the end of a major trending move. I'm talking about the end of a correction. Okay, a lot of your C waves, which is the end of a correction, will do this V top, V bottom kind of a deal. So you'll slam right down into the area. You'll get the huge amount of volume, which you have here. You've got the 2-bar pattern, right? I said if I were short and I didn't make it to the area, if I got a 2-bar pattern on the 5-minute, I would close the trade no matter what. Okay, that's that 2-bar pattern there. Big selling climax followed by a churn bar, you see? that means you have very clear demand coming in right there. All right, now, one thing I did start to say was, this is probably a good example of that. There's something called a shift median line, and that's anytime you have a really strong initial wave down, you would want to draw what's called a shift median line set, but I don't want to focus on teaching you guys market geometry today. But that's a shift median line set. So if you have a really steep A wave down, shallow B wave retracement less than 50%, you draw that shift median line, and there's your center median line right there at the low. All right, but that's a bit nuanced, and I don't want to confuse you, even though I think I just did. All right, so these couple of channels here are out of the question. We've already broken them. You don't need those on the chart anymore. Yeah, this one we've already broken. All right, now we're coming back up into, what time is it? It's starting to get deeper into the morning here. So at this point, I've got a potential area for a tiny retracement long. That's a really strong, fast move into that. So I wouldn't even consider that out of what is looking like a C wave low. But what I'll do at this point, you see how this is a lower low than back here? So this is actually the end of that first wave down. The way that the market geometry button draws these is it draws to the swing that is the widest. It's the furthest distance perpendicular to that baseline. So that's why it selected this one automatically, but this is actually the lowest low there. I do that for a particular reason. I won't get into it, but in this case, this is the proper anchoring of that line right there. But I wasn't even thinking about that when I was talking about it. But here you did make it to that median line. So at that point, you do have an area just a little bit higher at the baseline, but this is looking like such a strong move to the upside that I'm not really looking for a short at this point. So what am I looking for? I'm looking for the next major area of supply and demand. And at this point, it's not looking like I want to be shorting a move that's going straight up, you see. So I may consider a long if we get a deep enough retracement on the 5-minute. We've already broken back through this trend line, so I'll delete that one. We've broken this one as well, so I'll delete that one. Now we're getting a little bit later into the day here. This sort of thing is a little tricky, these little slightly higher low deals. I'm not going to try to get into that in this session. For the rules that we're using, we couldn't possibly catch that one anyway, so I'm not even going to talk about it. This is a totally different trade type. You would have to have a specific test for those. As you're doing this and you're thinking about doing this yourself and you're trying to record some stats that you would be able to use, you need to think about trying to keep what you're testing, what you're doing, I was going to say relevant, but basically you want to have, like I mapped out, we need at least 2 different areas from 2 different charts. And I need to have some confirming volume. I need to have a churn bar in the 5-minute or the 90-second chart, right? And I don't want to use these really massive swings. I don't want to try to take a short as the market has been going up for 3 days straight. I'm looking more for kind of a trending move, and then I'm getting in at the end of a type of ABC kind of correction up to a certain size. So you want to have at least some constraints on what you're doing. And one of those constraints, again, was at least a 40-minute retracement. And of course, that's not a 40-minute retracement. So if I wanted to add something like this into it, because we did have that big 2-bar pattern on the 90-second chart right there. You also had one at the high, you see. Big buying climax followed by a churn bar, very clear supply coming in right there. Big selling climax followed by a churn bar, very clear demand coming in here. Well, then I would have to treat this as a separate trade type and log that separately. Or, if I had all the rules clearly defined, I could log them both at the same time and then filter that and sort it in Excel after the fact. Does that make sense? You want to try to keep some similarities between the trades that you're taking, so that the data that you're producing is at least useful to you. You understand what I'm saying? There's a right way and a wrong way to do all of this, and most people just do it the wrong way. They don't necessarily consider all of the issues with how they're doing this sort of thing. It's just a very difficult thing to do right, and it takes a lot of thought and planning to actually do it properly. So we're getting past the close of the time that I'm even interested in trading at this point. So let's just go on to the next day here. We only got that one good trade. This is the problem with market replay. If you want to scroll ahead very quickly, if you're doing a month at a time, even a week at a time, it depends on how many indicators you have, of course, but market replay can take a very long time to get to the next section of market you're trying to continue your trade with. And with this, you can pause it, you can restart, you can close down. With market replay, you have to do the test all at once, which is a pretty big issue for a lot of people. All right, so we're coming into 6 a.m. here momentarily. Okay, here's 6 a.m. New trading day. Doesn't look very impulsive back to the upside, does it? We have a downsloping area up here. Of course, we're not really worried whether it's upsloping or down. We're in an uptrend, so we've got some major, just to point this out and make this very obvious, these are your major swings to choose from here. You don't want to use, well, you could use some of these in here, but I would prefer to use those on a faster chart. So you're looking for areas where you had very clear supply and demand step into the market. And then you're looking to forecast, anticipate the next areas of supply and demand. This is the most useful method for determining where that future supply and demand will come in. I hear a lot of people talk about you want to be reactionary. You don't want to be anticipatory. You just want to, have your rules and your indicators. And then when XYZ happens, you pull the trigger. Trying to anticipate what's going to happen is a fool's errand, and only idiots try to do that, and they always fail. Well, I suppose if you don't understand the way that supply and demand works, the way that the markets operate, then yeah, it probably would seem pretty foolish to try to anticipate what the market is going to do. But, when you've been using market geometry for any length of time, it becomes pretty easy to figure out where the next major areas of reversal are likely to be. So we've got a major low here. We're in an upsloping environment here. And I've got two highs. I could maybe do a parallel from this one if I wanted to, but I'm not going to try to confuse you. All right, so that's about all I need there. I mean, I might draw one from here. We didn't use that lower median line at all. We didn't use the center median line at all. That doesn't look very beneficial. So that's the tick chart. Yeah, that's another thing, JL, using the close or the extreme price. If there's a huge wick, I would use the close, but I don't want to try to get into all that right now either. Is there anything further back? There we go. So if you do scroll back a little bit to find a swing high, rather than scrolling forward and messing up your hindsight bias on the slave chart, just minimize this chart again and then go to your parent chart, the fastest chart that you have the trade tracker on, and just move it a bar or two. And that will automatically snap it to the proper bar. Okay, so on the 5-minute, I'm looking for some major areas of supply and demand. I've got, again, the obvious swing highs and lows. It's a pretty obvious high. There's an obvious high, another one here. Pretty obvious couple of lows. There's the previous one we used. Low, low. When these lows kind of do a little stair step like this, you may not necessarily use the lowest one, but the higher one. So let's just see. I'll draw from low to low. Yeah, we kind of go through it a little bit. I'll draw to here. We don't seem to be using the lower median line at all. So I'll just draw a straight channel there. Okay. It's really about all that I have. I could draw a trend line from high to high. That's about it. Okay, so we have very limited number of areas here. And then on the faster chart, aha, you see we were using that lower median line from here the whole way. 1, 2, 3, 4 times there. Yeah, oh yeah. Yeah, Raymond. Raymond's asking, do I still leave yesterday's market geometry on the charts? Of course. Yeah, don't even worry about time when it comes to this stuff. You're just looking at major areas of supply and demand. Don't think about yesterday, day before, previous week, or anything like that. That's sort of irrelevant. You're just looking for the major swings. Where did the high get put in? Where did the low get put in? Okay, so I could draw the same channel on the 5 minute as I have, or sorry, the same channel that I have on the 5 minute on here, but I don't really need to do that. So let's just start scrolling forward here. Now you might, if you're looking for some of these smaller retracements, you might connect some of these. And at this point, you do have a channel coming together here. You're sort of through that area on the tick chart, but let's just imagine that you were thinking this was an ABC high here, and you're looking for a lower high. Let's just be realistic about it. Many people would probably look for a short right here. Obviously, a lot of people did. You have a buying climax followed by a churn bar. That's pretty clear supply coming in right there, right? Pretty obviously. Let's see if we can't actually get a retest of that high and make it back to the top of this channel here. Yep, right there. So on that bar, you're getting through this area. So I can't really say that I have, well, if we get a churn bar in the next bar, I'll take it. No, I don't. So I don't have a churn bar at the entry. I had a churn bar back here on the 5 minute, but no actual churn bar. So I missed that one. All right, at this point, we're getting something larger that is actually what I was looking for at the time. I think a lot of you guys in the room ended up taking this trade. Looking for making it up to here. This is no good. We've already broken it. I wanted to make it up into here as a lower high, A wave down, B wave back up for a much deeper correction below 64, or at least down to 64, something like that. That's what I was looking for at the time here. So I'm looking to make it up to that area. That's the real main major area that I want to short. Actually, on the hourly, we had a downsloping upper median line there as well, but I won't get into that. So that's the next real major area for supply, the top of that channel there, okay? So let's keep going. Okay, we're there now, and I've got a downsloping median line on the 5 minute that we're busting through now. We're actually at 40. So we're up here at the top of the channel. So I have a center median line and a channel. That does count as two areas. I do count symmetrical moves as two areas. So it was at this point that I was looking for a retest and a slight break of that high. I think it came up, if I remember correctly, I think it came to like 42, and it missed my limit by 1 tick or something like that in the trading room. But let's just say I already took it because, I mean, you've got two massive churn bars back to back right there. That's a huge amount of volume coming in, confirming that area. So I click on tool. Let's say that I didn't get a very good fill and I got in down here. Now the stop, 2 times the average range on the 5-minute at least. To be safe on this one, since it is more like a 15 to hourly chart trade, I may set this to 20 ticks right there. And then I'll pause it now and now determine where I want my target to be. Guys, I know this is going a lot longer than any of you planned or I even planned, but let's just keep going. Probably going to take me at least another half hour. I'll try not to explain as much and just get some of this stuff done. All right, so at this point, what's my first area to exit? What do you think? Any ideas? Look at that huge, big, beautiful, massive 2-bar pattern on the 5-minute. Big buying climax followed by an extreme churn bar, very, very high volume per range. That's a huge amount of supply coming in. See, people would look at this and they would say, oh, that's increased volume to the upside. That's a huge amount of buying. But yeah, that is a huge amount of buying. But relative to how far the market was being moved with just very little volume to the upside, if that buying was being met with the same sort of amount of selling as it was back here, that market would have moved about 156. You see? So it's basically run into a brick wall at this point. And people are unloading their longs or building a huge short position right here. People that know what they're doing. That's what it looks like. Yeah, exactly, Ava. That would be the first spot, right? That lower median line there. Because we turned down from what? Where that center median line intersects the top of the channel. Right there. Perfectly symmetrical move there, which we saw in the last trade as well, which you see over and over and over. This is why it's so easy to prove market geometry is, well, I was going to say something crazy, but all right. I would say, yeah, make it down to at least that lower median line. That would be well over 45, 50 ticks. So that would most definitely be the very first spot. But I would also look to make it down to that trend line. And then beyond that, what am I looking for? Well, if I'm actually trading this to the downside and I'm thinking that this is an A, B back up, what am I looking to do? What do you think I'm looking to do? I'm looking to break that low, right? Yeah, that's probably a safe exit, JL. What's your name? Justin, that's right. Yeah, that's probably a nice safe exit as well. Justin's saying he usually takes his second contract off at half the width of the channel, which is this 50% warning line. So you don't always make it down to the main target that you're looking to trade to, but in this case, look at this. You've got your big upsloping channel here on the tick chart, right there at 65. You've got your big downsloping channel right there at 65. And it looks like you'll just be barely taking out that low if it makes it down there. So, I mean, I haven't seen as beautiful of a target as that right there. And, well, actually, we've been seeing a lot of this stuff in the ES and crude lately. So it has been setting up some pretty beautiful, massive trades recently. So that would be my target right there. My first target, honestly, would not be that lower median line in this case, because I would be looking to go straight down in a C wave. I would be looking to do something similar to what we had right here, right? Because that's what we're doing. When we're talking about corrective waves, if this is an A wave down, and I think that I've just found the end of the B wave, which I do think that I did here, which I just missed it by whatever. I'm looking to do something similar to this. You see? This right here from here. So that's what I'm looking to do. I just messed up our whole hindsight bias deal, but that's what I'm looking to do. That's why this is my ultimate target on the trade. Now, it may happen that I have to hold past the close to get down there, I don't really have a problem with that. But for the purposes of this test, I would close it before the close. So my first target will be the bottom of this channel, that trend line. So that at this point is at 65.70 on the minute chart and about 65.80 on the tick chart. So if we get down to there, I'll take the first one off with a custom exit. Otherwise, I'll get stopped out at 53. Now, I could make this thing go to break even after the first target. I've been trying to test that live, which is not the way you want to test anything. Please, guys, at the very least, don't test your trading systems in real time with a live money account. That is absolutely the worst possible thing you can do. You have to do this stuff with historical charts for a long time, a long period of time. Forget about the whole hindsight bias when you're looking at historical charts. Yes, you do have hindsight bias, but what you're trying to do is you're trying to take snapshots in your mind of what these successful trades look like and what the unsuccessful trades don't. Okay, but it takes a lot of time and energy to get to the point to where you can even start doing that. You have to do this kind of bar by bar work. You have to test ideas, figure out what's happening at these major, well, that's what I did. Tried to figure out what's happening at these major turning points, took screenshot after screenshot after screenshot, example after example, and then compared them all and came up with what I came up with. At least a couple of areas coming together on at least 2 different time frames with the volume confirmation and the divergence confirmation on the faster charts. So I came up with those rules after doing all of this work, trying to figure out what was happening at these major turning points. And then over time, it's kind of evolved from there. But now I'm getting back to trying to prove out some of the things that I think are true, but I don't really have any statistics. How many of you guys know somebody that markets a system that sells all this, does all this stuff and has all of these ideas about what works and what doesn't, but doesn't have any sort of, tests, results, live track record? They're just saying stuff that they think is true, right? Most books on technical analysis are like that. It's unfortunate, but that's kind of the way it is. So you definitely want to be able to do this type of testing. Now, I should be out there at 85, 65, 85. So I'll click on pause and then custom exit, 65, 85, right there, and then pause again. Yeah, exactly, Dennis. I know, man. I've worked with you on Bloodhound and Blackbird strategies too. It takes a while to come to terms with the fact that most of what we have paid for and learned is pseudoscience. What are you going to call it? I think it's people just trying to do the best with what they have, People see things that they think, in the market, we see all these things happen over and over and over. And we're like, well, I know this works because I see it happen over and over and over. Well, yeah, you may see it happen over and over and over, but does it happen often enough and in such a way that you can take advantage of it, that it's actually profitable? You may see something happen over and over and over, but that might just be a 49, 51, 2% against you. So just because it happens over and over and over and it's a recurring pattern, that doesn't mean it's a profitable recurring pattern. That's what separates the winners from the losers in this. Yeah, you see all sorts of patterns that recur over and over and over, sure. But can you take advantage of them? Do they actually produce more winning trades? Do they give you positive expectancy? Are you going to make 2 ticks on average per trade, or are you going to lose 10 ticks on average per trade? That's the question you got to ask. All right, at this point, we're heading down pretty strong. If I get a massive volume divergence with a churn bar on the 90-second chart, I'm going to get out of this thing. If I get a 2-bar pattern on the 5-minute, I'll get out of it Looks like we're making like a little ABC high right now. So we didn't quite get a 2-bar pattern there on the 5-minute. You might have been wondering about that. It is a high density climax, but that's sort of like a 2-bar pattern where the churn bar is kind of built into the climax, but it's moving down so strong to the downside that I'm not going to let that get me out. If it were one like, like this here, well, yeah, for the second contract, but I was just exiting the first contract right there. But if I saw this down here on the 5-minute, well, yeah, I would definitely get out. And I'm sorry for you guys that are not really familiar with how we're trading and all the terminology that we're going over here, that I'm going over. You're probably lost, but if I were you, I'd watch this video over and over again, because I'm sharing a lot of stuff that I wouldn't normally share. All right, there's the volume divergence with a 2-bar pattern on the 90-second chart. So I'm definitely out right there. You see? Good deal. Let me get this thing on again. Okay. So what is that? That's like, it's a pretty good trade. It's not a break of the low like I wanted, but you do have a hit of that upsloping channel there. Let me just, I think that's what you were talking about, maybe, Justin. It wasn't the 50, but it was the 100% width of the channel, right where that center median line intersected it. That's where we got the third wave low and then that fourth wave correction there. Yeah, that would have been a nice little exit. I used to do that a lot more, and I was pretty good at it half of the time anyway, enough to where it did help me, where I would get out on those really strong 2-bar climaxes. That is usually like the first swing of the next volume divergence. I would take at least half off or close it and then try to get in on that correction. Sometimes I would get into the correction early and I'd have to hold through a little bit of heat, but that's heat that I would have held through anyway, already being up as high as I was. So those are those areas where you can close the trade early. Sometimes you're going to regret it. Sometimes you'll be thrilled that you did do it, and then try to get back in at a better price. Once it starts moving like that, I mean, you've got a pretty good chance of actually making it to the next major area of obvious demand, in this case, since we're going down. How many of you guys are totally lost? I mean, I can remember learning this stuff for the first time and being so overwhelmed that I was ready to pack up and move home, basically. It's like, there's no way I'm going to learn this. So it can be overwhelming for sure. But it's like anything, If you want to be good at something, what are you going to do? You're not going to read a book, right? So yeah, that's the next major spot, but we haven't quite ticked out the low. Yeah, exactly. If it does nothing, Raymond, but that, if this can serve to at least and only keep you from over trading, well, that is a huge improvement. That's the number one cause of blown accounts. Over trading, holding on to losing positions, I think they go hand in hand, really. Once you start getting into that downward spiral where you're losing money, you make a mistake after mistake. You end up holding losing positions, and you end up adding to losing positions. All right, so anyway, that's volume divergence on the 5-minute. What do I mean by that? That's a big selling climax, straight down, huge amount of volume, retraces back up. There's your sign of strength. And then it comes back down to test that low on less volume, much less volume. All right, so in this case, it's starting to look like the selling is maybe drying up a little bit here. At this point, it's looking like a low is imminent here to me, based on all the stuff that I've done. We've probably got like a trend line from low to low here or something. Yeah. There's probably a number of other things. probably the VWAP on the hourly chart or something like that. All right, so at this point, I'm looking for a swing low, maybe a retracement back up. If we could come back into the previous fourth wave, the way I see this, what I'm imagining at this point is that we're at the end of the first wave down, or there's a couple of different things you could do with this. I don't think we're at the end of the move though, right? Because we haven't broken that low. Your C wave is typically going to break the A wave low. I don't mean to get into a Elliott wave training session here, but you tend to make it down below A and to the next major area of demand. Now, of course, the Elliott wave doesn't factor in all this market geometry stuff. They do a couple of basic things with trend channels and the end of a fifth wave and the end of a fourth wave, but that's about it. A lot of corrective waves do end at channels as well, but not always. Yeah, see, we still haven't ticked out that low. All right, now we're getting past the morning. All right, right there. That right there is, I don't know how much of this stuff I should reveal, but whatever. I guess most of you guys will forget it anyway. When you see a big buying climax like that,